Hello everybody and welcome once again to this NZX Retail Investor webinar. My name is James Sharp from the issuer team at NZX. Slightly changed to as billed. Sarah Hinnick, who was hoping to host, has been made unavailable at the last minute. No doubt we will see her again in the near future. Really looking forward to hearing from three of our issuers this afternoon. And just a reminder of the format, we're going to hear for about 15 minutes from each presentation, followed by 5 minutes of Q&A. And as ever, so we do encourage questions to be asked, and any we don't get to, we'll endeavour to get back to you after the session. A quick reminder of how you ask a question. So the webinar panel will be on your screens. It's a small text box. Just enter your question in there, and it will come through to the team here. And as I said, we will get to those questions as best we can. Fantastic, let's get started. So first up, delighted to welcome Marty Pomeroy, CEO of Smartpay Holdings. Smartpay are the largest independent full-service EFTPOS provider in New Zealand and Australia. Marty joined Smartpay in 2013 and brings over 13 years experience across the NZ payments industry. I'm pretty sure I've used the Smartpay terminal already today. I'm sure it's the same for the audience as well. So Marty, over to you, and I'll be back in a few minutes. Thanks.
Thanks, James, and I hope you had a good experience there. Well, I'm sure you did have a good experience there. Thank you, James, Anna, and the team at the NZX for the opportunity to present this morning. Good afternoon, everybody. As introduced, I'm Marty Pomeroy, CEO and Managing Director of Smartpay. I'm just going to now flick over to my presentation. Bear with me, please. So I've just put together a brief presentation this morning, as James highlighted. I've got about 15 minutes, so it's only brief, and then I welcome questions at the end of the presentation. I appreciate many of you will already know who we are, but I thought I would start with an overview of the business and give you some insights into our current opportunities and how we're going against those opportunities in market, specifically our key growth areas. We operate on a March financial year. So I've got our most recent financial year results to March 21, and I'll take you through the highlights from those results. And finally, I'll provide a bit of a summary and an outlook for us for the next 12 months and beyond. As mentioned, I'll then welcome any questions. So who is Smartpay? Smartpay is a merchant-facing in-store, or what we describe in the payments world as a card-present payment provider. We have a trans-Tasman EFTPOS payments business. We provide in-store payments acceptance devices to all types of business, predominantly in the small to medium enterprise segment across both New Zealand and Australia. Our current terminal network at present across both countries is over 37,000 devices, and we have over 15 years experience operating in this space. In New Zealand, we have a mature business holding a reasonably significant position in market where we provide over 30,000 terminals, and that's predominantly on a fixed term rental model, reflected in a fixed monthly revenue in our accounts. Our New Zealand business provides the head office functions and operational leverage, including our finance and engineering and technical capability and capacity, supporting our Australian growth. In Australia, we have a smaller but fast-growing market position. The key difference between our offerings in the markets is in Australia, we provide a full stack, or what we describe as a full stack in-store payments experience, including settling to the merchant their daily card takings. In payments terminology, this is called acquiring. Acquiring is best defined as the charge of a nominal fee to the merchant or the card holder for the acceptance of their credit or debit card transactions. That's largely or mostly reflected in a transactional revenue model for our Australian operation. It's into the Australian market, as I stated, that we're having most of our growth at the present point in time. So I will spend the next few slides focusing on this opportunity. So a quick look at the growth opportunity in Australia. The total in-store terminal market in Australia is approximately 1 million devices. We're targeting the small to medium enterprise segment of this market as we have significant IP and experience in the space. We've done research and have pegged that size of the market, or that part of the market, to be circa 250,000 businesses, so quite a sizable opportunity. The remainder of the market can be categorised as medium to institutional sized businesses. In the last 5 to 7 years, changes in the acquiring regulations in the Australian market have allowed for new entrants to enter, which up until then had been the domain and the sole domain of the major banks, with some of the second tier smaller banks also participating. As such, the majority of the addressable market that we are targeting is supported by legacy providers, so the main banks, and that's what that graph, I guess, in the top corner of the slide here represents. And it would be fair to say that the solutions in market at present that are supplied to the small to medium enterprise space can be best described as, I suppose, meeting the hygiene factor from a payments experience. The existing or incumbent providers are largely structured to support the medium to institutional end of the town, and struggle to provide direct engagement with customers in the small to medium enterprise space, which is our specific target market. Pricing structures for solutions provided by the existing providers are also often complex and difficult for small to medium business owners to fully understand. And then they're required to financially unbundle on a monthly basis the costs associated to those solutions. Finally, with the ongoing evolution of digital payment types, including wallets, phone, wearable-based payments, and QR code acceptance, also cloud-based SaaS model POS companies, the existing providers are not well placed to participate in what would be described as a technology arms race. So how are we different? We have extensive payments IP, as I mentioned, over 15 years experience in the in-store provision of payment solutions. And I guess one of the key differentiators from the large incumbent providers is we truly understand our target audience and have scaled our business to support them effectively. I just want to spend a little bit of time now on this slide because I think it goes to the heart of how we think about our customers' needs. We've got two key propositions in the Australian market. The first we call zero cost EFTPOS, and we've branded SmartCharge. It's quite different to the other surcharge type products that are on the Australian market, and we've managed to achieve that through our engineering capability. At a basic level, SmartCharge allows our customers to pass on to the cardholder an agreed cost of acceptance. And I won't go into detail on the competitive advantage, but if I can describe that in the customer experience way, we set the fee that is charged to the cardholder. So when one of our customers receives the device, we set the fee. That's really important because it ensures that we meet the compliance and regulated environment of the Australian market. We also provide the customer the ability to charge for every transaction they do. Many of the solutions in the Australian market exclude things like contactless cards from being charged. We also settle the funds to our customers the next day, minus the charge that has been passed on to the cardholder. And that's really important for small businesses because it ensures that they can manage their cash flow simply. In essence, all of the funds that are deposited to the merchant on a daily basis are theirs to run their business with. Our business is a customer-centric organisation, and I think that's best reflected in the sizable position we've been able to realise in the New Zealand market, which is highly competitive. And we focus on ensuring and focus on, I guess, executing into opportunities for our customers that build long-term brand value and a stable organisation. I guess ultimately at the end of the day, our customers are our best advocates, and we love nothing more than receiving referral business from our loyal customers. So I won't go into too much detail again about necessarily specific verticals we're targeting because we see there's some competitive advantage in those, but we are targeting certain verticals in Australia at the moment, and this is one of the most recent case studies we've done for one of our customers that talks to the difference, I guess, that we are making in their business and then how they're applying the proceeds from the product that we provide them with to help grow their business. I think this really highlights and resonates why we're being successful. I guess the other key point I would make as well is that in a COVID environment where businesses are facing uncertainty and new challenges that they haven't had before, things like cash flow certainty and removing complexity for customers is more important than ever and is really resonating. Key metrics and KPIs for our organisation, and particularly our Australian business. So our Australian business is fundamentally a sales and marketing structure. As I said, we leverage much of the operational capacity we have in New Zealand to help with our growth efforts. A few key metrics. We calculate our customer acquisition costs, including marketing, sales, hardware, and distribution costs, and then we work that out versus the revenue and margin we make for a customer, and we calculate that gives us about a 5 to 7 month cash payback period. So a very positive KPI for our business. The average ticket size of our merchant portfolio is between $30 to $40. The average ticket size is basically the average transaction that gets done through one of our terminals. It's an important point and key metric, and one of the reasons that we're focused on the SME market is because the on-charging of a surcharge for card usage is nominal at that average transaction size. We've seen steady growth in our acquiring margin over time in our Australian business also, and this is a function of more of our customers adopting our Smart Charge product as we grow versus the fixed rate product, which is a lower margin product. But that's a really important, I guess, key metric and KPI that many of our investors are interested in. We also chose to enter the market with a particular partnership around switching, and I guess it's a really important point of differentiation for us in the Australian market, as we get to take advantage of variable cost volume-based transaction processing rather than owning and maintaining the compliance across a transactional processing switch. We think it's a real clear point of difference for us in Australia. The graph on the right-hand side shows the stable revenues we realise from our New Zealand business with the high growth in revenues that we've realised from our Australian business over the last 3 financial years. I'll now briefly cover off the results from our most recent financial year. We're actually very pleased with FY21, obviously in very challenging conditions, not only for our customers, for ourselves as well. Overall revenues were 33.8 million, up 19.7% on the prior year of 28.3, with our Australian revenues showing strong growth throughout the reporting period. The Australian acquiring transactional revenue grew to 17.1 million, an 80% increase on the prior year. The growth in Australian acquiring revenue came as a result of our continuing effort and investment into the core sales and marketing functions that we're engaged in and activities that we're engaged in towards our addressable market opportunity in Australia. Our monthly customer acquisition continued to increase throughout the year and actually resulted in a record month in March 2021 and reinforces our view that we have solid propositions going to a highly interested market. EBITDA grew to 7.6 million in the period, up slightly compared to the prior period of 7.4, which again, we're very pleased with given the challenging trading conditions experienced by many of our customers through the COVID impacted period in the financial year. Briefly, in summary, the last financial year, I guess, demonstrated the resilience, particularly through the COVID period and the lockdowns experienced in New Zealand, of a very resilient New Zealand business with very loyal and stable customers. It also further validated our growth story into the Australian market and that we're successfully executing into the opportunity. Whilst we see ourselves as still in the early stages of our growth phase, we are scaling quickly and we now have a well-established sales and marketing capability. FY22 and beyond, we'll see Smartpay continue to develop our payments offering in both countries, broaden awareness of our brand and competitive product offering in Australia, and further scaling our Australian revenue, which is expected to deliver operational leverage and EBITDA growth. Thank you. I now welcome any questions.
Thanks, Marty. That was great. Really sort of comprehensive, some real tangible use cases there, I think, from the small business, medium business perspective. Do you have a few questions? We've got time for perhaps a couple. First question is, how have the recent lockdowns in Australia impacted the business from signing up new merchants?
Look, sort of two parts to that question. So maybe if I separate it out. So how has it affected the business? Look, we put a trading update out, I think latter part of last month, and sort of talked about the effect that we'd had about, I think, 11 days lockdown in Melbourne at the start of the month, and Victorian lockdowns, and I think about 5 to 6 days towards the end of the month of June in Sydney. And look, it does have an effect. It's an interesting one because Victoria's lockdowns were very much full lockdowns. Sydney certainly seemed to be staged. The way we describe it in terms of trying to give investors insight into what the effect might be is that a week lockdown in any state probably has about a 4% impact on revenues. And so if you think about it in that context, if it's across a couple of states at a week at a time, then you can kind of extrapolate that out. We don't provide guidance, but I note that the analyst that does in Australia, CCZ, put out an update off the back of our recent trading update, which I think gave a sense of what it might look like. The challenge is trying to figure out, of course, as our customers are, the length and severity of these lockdowns. Some states seem to come in and out of them pretty quickly. New South Wales obviously having a pretty hard time of it at the present point in time. And I think the second part of that question was?
Just the effect of signing up new merchants.
Yes. Look, we've been pleased with our ongoing momentum there, actually, it would be fair to say. I think it talks to the resonance that our sort of core proposition in Australia is having with our customers and with the target market we're taking it to. As I said, it's an uncertainty for a small business. They become very much focused on cash flow as king, right? There's less of it to go around, and they've got all of the challenges in their business to maintain. So I think that the cash flow assurity we provide them with is really important. But I think also removing the complexity. Many of our customers are time poor, obviously, as well. They're doing many jobs and many roles within their business. So I think we remove the complexity from that cost in their business, which just gives them more time to get on with running their business. So I think those are the two core reasons why we're really resonating. And we're quite direct in talking to our audience about that as well, that we think it will make a difference. So yeah, we've been pleased with our momentum.
Great, fantastic. And probably time for one more. It's a slightly longer one, so I'll read it out. Bantim, has Smartpay been impacted by the Westpac transaction issue from overnight? How do you ensure that the linkages with financial institutions remain safe and effective? And how does Smartpay view and manage risk? So there's kind of three parts to that. I can repeat if you need me to.
Yeah, I mean, the last part is probably a lengthy conversation, so maybe we'd pick that up separately. But if I can talk to, because obviously, there's many deep answer to that piece. But if I maybe talk to the first two, so in essence, if our customers have a trading account with one of the banks and one of the banks has an issue or an outage, then it may affect them on a trading account basis. So if they have maybe an issued card, then you might find that card type or that issued card has problems transacting with our terminals. But in essence, the links with the banks on that in that context don't have an effect on us, to be really clear. In New Zealand, our terminals talk to a central processing switch here, Paymark, and Paymark manages the links to each of the banks for card holders and also for settlement experience. So some of our customers may have been affected by that. Those things would be outside of our control in essence, and wouldn't affect the ability for our terminal to broadly transact. It's very similar in Australia, even though we're involved in the settlement piece. Again, we partner with a transactional processing switch in Australia called Cascale, and they manage the linkages with those banks. So again, doesn't necessarily directly affect us on a scaled basis, but might lead to some interruption for card holders, etc.
Yep. Okay, fantastic. And we did have another question, which we'll probably fire through to you after the session, if that's okay, Marty. Because
I'd welcome that. Yep, I'd welcome that.
Perfect. Okay. Well, thanks very much for joining this morning, Marty. Great to hear from you, and see you again soon. Enjoy the rest of your afternoon.
Thank you very much for the opportunity again. Good to speak to you all this morning. Thank you.
Cheers, Marty. Thank you. Fantastic. Okay, we're going to move on now to our second presentation, which will be from Blair Turnbull, from CEO of Tower insurance. So Tower is a Kiwi-grown insurance company that has been listed on NZX since 1999. Tower has been supporting Kiwis for 150 years, providing its customers with cover for their houses, cars, contents, businesses and more, both across New Zealand and the Pacific Islands. I have to say there can't be that many 150-year institutions in New Zealand, which is fantastic. Looking forward to hearing about the years ahead too. So over to you, Blair, and I'll be back in a few minutes with some questions. Thank you very much.
We just pop on to the next one. I'll talk to you a little bit today. Welcome the opportunity to talk to you about insurance and in particular in Tower. So on the screen, if you can have a look at the little diagrammatic on the left-hand side, the one that looks like the measles chart, that's actually the last 10 years in New Zealand with earthquakes, and it looks quite concerning when you see it like that. The chart on the right-hand side is an elevation map which highlights all the low-lying areas in New Zealand, and part of this is answering the question of why is insurance important to New Zealand, and that's because New Zealand might surprise some people, but it's the second riskiest country in the world for perils. And lots of people know New Zealand around earthquakes and Christchurch. That's the chart on the left. We have a lot of shakes, but the one on the right is maybe less well known, and that is we have a lot of floods, and a lot of obviously coastal areas is open to flooding, alluvial and pluvial flooding, and that's what makes us the second riskiest country in the world for perils. As a result of that, no surprises, we have one of the highest penetration rates of general insurance of anywhere in the world, over 90%, 96% for house, and just below that for motor. Tower itself, we've been around for 150 odd years, and we've been doing that for probably for the first 140 years. We did it for a composite insurance, we did life, we did health, investments and general insurance. Most importantly, for the last 10 years, we've just done it around general insurance. And that's been as a result of the Christchurch earthquake, which really put us a focus around general insurance. As part of that, we really reinvented ourselves over the past decade, and we built, looking to really build a leading business that's based around technology, digital and data. And that's how we differentiate ourselves from the competition. So we've got a market in New Zealand. We do have a lot of perils and accidents, etc. And a big part of how we're differentiating is around digital and data. If we look at the market itself, 70% of the market, a $7 billion market here in New Zealand, is dominated by two players, two Aussie insurers. We are the third insurer in the country, and we have around just under 10% market share. Thanks, Anna. You're doing well in terms of jumping through. We go to the next slide. So how do we play and compete? At the heart of what we do at Tower, it's around creating a ruthless focus on the customers, building a beautifully simple and rewarding experience. And we do that in a couple of ways that makes us different to those other insurers I mentioned before. And that is a real focus around growth and innovation built on digital and data. We have a leading direct business, which looks quite different to a traditional insurance model, which is built around brokers. And we look to partner wherever possible. And I'll talk to that a little bit more in a minute. We do it with insurtechs. We do it with all sorts of different retail partners as well, which is a little bit unusual for an insurance business. Of course, at the end of the day, we are all about paying claims. And so core to that is having a really strong underwriting insurance fundamentals and having a really strong capital and solvency position. And just capturing all of that, one thing that we've learned certainly with Tower over 150 years is we're very, very focused about what we do now. We are a personal lines, small to medium-sized general insurer. We don't do life, we don't do health, we don't do those other areas. That's what we do, both in New Zealand and also in the Pacific, where we are with 8 countries. Thanks, Anna. Just going on to that and sort of unpicking it a little bit more, how we're organised is around 3 businesses at Tower. There's a Towerdirect business, which is our flagship business. We have a partnership business, and we have the Pacific business. But underpinning all of that is our cloud-based digital and data platform. We're 100% on the cloud. One of the key, I think, success factors of any insurance company is the efficiency, but in particular, eliminating the complexity. Insurance is, renowned for the complexity, and core to our success and growth and innovation is that we set up everything on a core platform. And as part of that, about 5 years ago, we rationalized our product set from around 400 down to 14, and that product set now is personalized for each of our 3 businesses. Roughly, we now have north of 300,000 customers. We have about 400 million in annualized premium, and we had, as I said before, just under 10% market share. So maybe let's go into a little bit of these businesses in more detail if I can. Towerdirect is our flagship business. It's the largest direct general insurer in NZ with around 187,000 customers. We have an annualized premium, about $250 million in annualized premium, and it's our most efficient business because it's so very focused on the digital and data side of it. And we run the management expense ratio about 31%, and that's a sharp improvement on this time last year. These figures I should highlight are from our March year-end numbers. So just when you're seeing those, take that into consideration, March year-end, so 31% down from 35. And we've really built that out through the online experience. We love telephony. We do a lot of business, over 700,000 calls per annum, but we do a lot of our business online. 2/3 of our new business now is coming online, and we reflect, the consumer trends at large in the market. Just turning on to the partnership business, and as mentioned, it's a little bit different to other traditional insurance companies that have sold through brokers, through higher commissions, through long-tailed bank assurance agreements. What we've looked to do here with Tower and different is look to partner with retail partners, TradeMe, which in NZ's case is one of the largest retail brands, 1.7 million customers. We've just renewed that special relationship with TradeMe for another further 5 years, which has been very successful. When we look at corporates, we have established a number of corporate relationships with the likes of a CSC buying group, which have corporate partners like a Xero or et cetera, and we're putting offers through directly to their employees. Also recently announced NZ Defence Force, which opens the door to the large government-based opportunities, and we also work with the Auckland Council. And so how it's different is we are offering through digital increasingly, but also offline on telephony, we are offering Tower directly to those employees, and we're using promo codes, etc., to support them around their insurance needs. We also form relationships with insurtechs, and that's a little bit different because we have a 100% cloud-based platform and a very, very good API layer. We've recently announced partnerships with Centro, which is a group scheme, which is pretty exciting, and Open, which is one of the leading insurtech providers from Australia, and now they are looking to launch themselves in New Zealand, and we're thrilled to partner with them, and we'll be doing that in the second half of the year. So hopefully you can see it's quite a different partnership model, and now we're starting to really establish and set ourselves up for growth in the coming months and years. Our third business is Tower Pacific. We've been in the Pacific for 125 years, over 8 countries. In the past, we have had a very unique proprietary setup. It's been very manual. We've literally been putting policies on mopeds and getting them out to customers. Going forward and starting with Fiji, we're now putting that core digital data platform that we have, and we're actually rolling it out to Fiji and all of the countries that we work in the Pacific for the customers. The one thing we know in all of those islands is that all of our customers have a telephone. It's a real struggle if you need them to come in from the islands and come into the office. So through mobile and the like, we can do that. Okay, that's Fiji. If I can just turn on to the next one, Anna, that would be great. So underpinning all of our businesses is the Mytower Platform. It's really focused around growth. It's focused around efficiency. Since we launched it a little bit over a year ago, we've now got north of about 125,000 customers on Mytower. So the registration rate, you can see there in the chart, is growing very strongly. 2/3 of all of our digital sales for direct are now online. So this looks quite different to a traditional insurer, which is quite exciting. What we also know is once we start to get those customers onto Mytower, they become much more engaged. Their longevity pushes out twice to that of a single product holder. So they stay for more like about 6 or 7 years, and we start to deepen the relationship. And that's at the heart of it. This is no different, I know, to many on the line realize this strategy. It's one that's played out for obvious brands like Amazon and others online. And insurance has been slow to adopt this, but actually you can see from Tower, we're embracing it in a really positive way. And that's what we're looking to do with Mytower. If we just go to the next slide, by having the platform, by moving insurance from an annual event where you come in, you pay the premium, you look at your renewal, we're looking to make it a more everyday event, helping with preventative and protective insurance. We're looking to engage customers, and part of that strategy very much is, you go home at the end of today, you drive the car, you go home to the house, you have your jet ski downstairs, the pet comes and greets you at the door. We want to bring all of those insurance moments in a really nice, beautifully simple, easy and rewarding way into one place. We know customers struggle with insurance. A lot of customers tell us they find it really confusing. Our mission is to really simplify that relationship, bring it into one place, Mytower, in a really nice, convenient way. And you can see here on this page, over the last 12 months, we have put together boat insurance online. So we're the only now Kiwi insurer who goes online with boat. We do barracks cover, which is quite unique, with the New Zealand Defence Force. We've launched Pacific Motor and Home and Contents more recently in Fiji. We are working with Allianz, the world's largest insurer, to bring pet and travel. Pet will go live in the next few weeks. Travel, sorry, will go live in the next few weeks, and pet will be in the next couple of months. But in addition to that, we recognise clearly that consumer behaviour is changing, certainly here in New Zealand. Everyone's focused on electric vehicles, e-bikes, scooters, and now all of our cover has evolved because we have the digital and data side of it. We've been able to offer those products and launch all those products in the last year. And so what it's bringing together is insurance in a very easy way, which is what I know all our customers are seeking. That said, there are certainly some headwinds in the case of insurance, and we're not immune to those. Inflation has been biting hard, certainly more recently, and we came out with some announcements earlier this year. We were seeing inflation around both motor and home, and you can see we've also more recently had a number of large events. I came back and took on the role of Tower about a year ago as CEO. In that time, we've had 9 large events from Ohau fire, we've had Napier floods, we've had hailstorms in Motueka, we've had a tornado in South Auckland, we've had Canterbury floods in the rural areas, and more recently we've got the Westport floods. And that talks back to the original point that I mentioned, is that increasingly we are seeing these large events. We do have a lot of shakes, and that's why insurance is so important to Kiwis and broader. And you can see there in the chart that clearly a big part of the challenge is managing those large events. That's why we're here, of course, and why we work closely with the EQC, and we want to manage that and manage it effectively. So that's some of the headwinds. Having said that, if you wrap it up, Tower is we're 150 years old, but we're a very different business today, and very focused around general insurance, very focused on the data technology side of it, our personal lines and small to medium sized commercial. If we look at our underlying impact, we've now had a solid track record of profit over the last 4 periods. Yes, we are very careful to acknowledge that we do have inflation coming through. Those are some of the headwinds, but over the long term, that story of attractive long-term growth remains steady, and we're in a good position now to really grow and innovate the business. And supporting that, if I just turn to the next slide, Anna, we're in a really good, strong capital and solvency position. I think at 309%, I would argue after 25 years in the industry, I think we're the most solvent insurer almost anywhere. That's a pretty good figure. The baseline for a lot of insurers are around 200%. So at 309%, we're in a good position. We don't have any debt. We have excess capital. We have a very strong rating at A-, and we are now, have left behind us a number of the legacy issues like Christchurch of the past. So we're very much now in a strong position and looking forward. So in terms of just summarizing that and bringing it together on the next slide, Anna, we believe Tower is in a good position. It looks like a very different Tower of the past. It also looks different to our core competitors here. We are a direct play, unique partnerships, unique footprint between New Zealand and the Pacific. We're the last listed insurer in New Zealand, and obviously listed also in Australia, which makes us quite unique as well. And through the digital and data platform, through our partnership model, we're really well positioned for growth. So that sort of brings a little bit of the presentation in, James and Anna, and if you like, happy to open it up to questions.
Great, thanks very much, Blair. What a busy year it's been, has to be said. Really great to see all those points across the presentation. You've probably got time for one question. I think you've touched on some of this already, but maybe if you've got anything to add, how do you see the use of technology and AI changing your business and the wider industry?
Yeah, look, I got all excited a few years ago when I was leading the digital operation for Aviva, and I thought, great, I'll be focused on digital. I realized very quickly, actually, it's a data business, and at the heart of what we do with insurance is the data around a direct business, how we get the right offers, personalized offers to individuals, whether that's bundling up home and motor and so on, but also the data is so critical to us with underwriting. At the end of the day, insurance is about a lot of maths, and so if we can get data sources, on average we have around about 1,300 data points on every one of our customers. That could be according to the risk profile of their house, to perils like earthquake and flood and crime, and we put all those together, and then we can paint a really good picture what looks like in terms of the underwriting risk of a customer, and at the same time we put the data in the digital to reaching a customer on their phone in a really nice, simple way. They can either call us or they can do it all through Mytower. So, and sitting behind that is algorithms, AI algorithms, working out all the pricing models and working out all the risk in the underwriting, and also all on the direct side with next best offers, etc., working out the marketing and the revenue side. And by doing that, we can lower our cost to acquire new customers, build deeper relationships, and just have a much better experience.
Fantastic, great stuff. And probably got one very quick, another one. Again, I think you've touched on this. Extreme weather events predicted to increase due to climate change. How will you manage the risk ratings and pricing models to accommodate? So I think you mentioned that towards the end of the presentation. Anything to add there?
We just look, we hoover up a lot of data. We work very, very closely with partners on the data side, RMS, CoreLogic, you name it. We use right around the world, we use data sources around perils. We do live in the second riskiest country in the world because we have a lot of those perils. A lot of effort goes in. We work with all the universities around New Zealand to develop that, and it's core to understanding it. How we're different to some of our competitors is we do risk adjusted pricing. We look at you as a person, you as a customer, where your home is, how you drive, whether it's through a GoKarma app. We put all those things together, and then we get a really good picture. On average, 1,300 data points per customer. And then we can get down to a personalized price. That is quite different to our competitors who tend to smooth over the country. But we believe that means we are very competitive in the areas we want to be, and we price the technical price to areas that have higher risks. We don't do an embargo. We still look after people in Wellington. We know the high zone for earthquake. It will cost you more money, but we won't embargo, but we do price according to your risk.
Great, fantastic. Really fascinating, Blair. I think we'll leave it there because we'll move on to the final presentation. Thanks very much for having you on this afternoon, Blair. I'm sure we'll see you again in future. Enjoy the rest of your afternoon, and any other questions I do say to the audience, please fire those through. We'll get them over to Blair.
Cheers, James. Thanks, Anna. Thanks, everyone. Pleasure.
Thanks, everyone. Thanks, Blair. Fantastic. Okay, let's now move to our final presentation of the afternoon. We're going to hear from Todd Hunter and Aaron Saunders, who are CEO and CFO, respectively, of Turners Automotive. Turners Automotive is an integrated automotive financial services group with leading brands such as Turners Group, AutoSure, and Oxford Finance. Certainly a household name. I'm sure many of the audience may have driven a car today that was bought at Turners. And with that, I'll hand over to you, gents, back in a few minutes with some questions. Thank you.
Thanks, James. Just want to confirm you can see our screen.
Yeah, we can see your screen. Yeah.
Just quickly put that into presentation mode. You can see it again there, James.
Yeah,
great.
Perfect. Thank you.
Okay, thanks, and yeah, thanks everyone. Just wanted to introduce myself, Todd Hunter, Group CEO for Turners Automotive Group, and Aaron Saunders here on my left, who's the Group CFO. So Aaron and I have both been around this Turners business for a period of time. We actually both started in 2006, almost within a month of each other for the business that was listed, Turners Auctions. So we know this business very well over that time. Turners Automotive Group is an integrated automotive financial services group, and there's really kind of four key components to it. Those people on the call will no doubt recognise that the Turners brand. We're the largest second-hand car vehicle retailer in New Zealand. And the integrated nature of the business is that we have a finance and insurance business which sells products through our own auto retail network, but also through a network of third-party dealers and brokers. So it's very much centred around the buying and selling of used cars, but then the adding of those additional products into the product journey that we take customers through. The last sort of component to the business is that we own a credit management business, which is fundamentally a debt collection and recoveries business that does debt collection work on behalf of the large banks and big government departments and corporates in New Zealand, and has some customers in Australia as well. Just a little sort of view into our track record, and then I'll move shortly through into really kind of the growth trajectory of the business. So this is just a little view of the business sort of over the last 11 or so years, and as you can see, it's quite a step change from 11 years ago. So that was the business Dorchester Finance out of the back of the GFC. That business then merged with the business Turners Auctions in 2014. And since then, there's been a number of acquisitions, but the most material acquisition has really been the merging of Turners Auctions, the big wholesale vehicle retailer, with the Dorchester Finance business. So as you can see, we've just come off the back of a record profit year in FY21, producing just under 37.5 million in pre-tax profit and paying out 20 cents per share to our shareholders. And the business is valued at around that $370 million mark today. Just a quick note, people may notice and wonder why the FY20 valuation was so low. Well, that was taken on the 31st of March, last year, which obviously was quite a low point in terms of market valuations. And thankfully, things are looking a lot different now. Just to share with you our vision is to be New Zealand's leading ecosystem for vehicle users. So whether you are buying a car, subscribing to a car now through our Turners subscription service, whether you're financing a car, insuring a car, or selling a car, we have all aspects of that vehicle ownership life cycle covered. So our vision is very much to be the New Zealand's leading ecosystem for vehicle users. We feel like we're delivering a really good track record of growth in this business. So these two graphs just show profits in 3-year bands, and the dividends that we've also paid out to shareholders in those 3-year bands. So you can see we have really delivered a lot of growth over the last sort of 12 years. And what I can tell you is that we are absolutely on track for another step change in profit and dividends over this next 3-year period, which include obviously the last financial year and the financial year that we're in now, and the FY23 year. We have had really a very good year in the FY21 year, and we sort of saw the early signs of a number of initiatives that we've been putting in place over the last 2 to 3 years, really sort of halfway through the FY20 year. So last year we achieved 19% growth in normalised pre-tax profit. We delivered 20 cents of earnings out to our shareholders and dividend distributions. And based on a share price of around $4.30, that is a gross yield of 6.5%. It's one of the highest yielding stocks on the NZX. And we feel like we really have honed in on our recipe for growth. So the recipe for growth is built out around an omni-channel experience, and particularly in our auto retail business. And a bit like Blair was talking about for the tower business, it's very much based around digital and data investments. We have been doing a lot of work around optimizing our retail channel, both in a digital sense but in a physical sense around our branch network. And then lots of really good changes in the finance insurance business, but particularly in the finance business around the way we price our risk and our ability to target and grow that finance book in the high quality borrower segment. So that recipe for growth is really starting to get traction and kicking nicely into gear. And we've certainly seen a very strong start to our FY22 financial year. We'll give some further colour to that next week. So a little plug for our annual meeting next week on the 18th of August, 10:30 a.m. We'll give some more colour to that next week. So really from here, I just wanted to sort of share a bit more about how we see the business kind of tracking from here. One thing we did share with shareholders at the annual results presentation in May is sort of how we viewed the next 3 years and our trajectory for growth. And that our goal is to deliver sort of 30+% increase in underlying profits over the next 3 years, and we feel very confident that we can deliver on that. One of the reasons that we are gaining confidence around the future is the higher proportion of annuity earnings that we have in the business now. So across those 4 businesses that I talked about, auto retail, finance and insurance, and the credit management businesses, they are a mix of annuity and activity-based businesses. So the finance and insurance businesses, being the annuity businesses, now account for well over 55% of our earnings. And so those annuity earnings just give us more consistency and more stability in our profits. We feel like our businesses are really well positioned for, a well-used phrase, but the new norm, sort of, so in the COVID environment. And I just want to touch on a couple of points here. So one, used cars and the used car market have demonstrated really strong resilience. So we know, both Aaron and I being involved in this business through the GFC, that used cars are much more of a needs-based purchase than new cars. And so, again, we've seen really strong resilience in the used car markets and the used car numbers being transacted over the last 12 months. And we've seen the benefits of having really a diversified business in the auto retail business, diversified in terms of geography. So when we've had these regional lockdowns, we've been well insured, and also our diversified sources of supply. So there'll be many people on this webinar that will have read about the constraints in the new car markets and having diversified sources of supply. So for us, 90% of our cars are sourced locally is a is a really important thing around reliance on supply. Both the finance and insurance businesses have been obviously very helpful, particularly in those lockdown situations. So the businesses still continue to earn, despite the fact that we might not be generating origination. And our de-risking and focusing on quality and our pricing for risk strategy has worked very, very well in both the insurance and finance businesses. And then just to sort of add to that picture around diversification, our credit management business has a very strong kind of defensive, counter-cyclical aspect to it. And interestingly for us, when we kind of went into lockdown last year, we were expecting the credit management business to be one of the higher performing units in the kind of business portfolio. And in fact, they've had probably the toughest time of all of those four businesses. But we know that as the cycle changes, there will be more debt to collect on behalf of those big corporates that we do business for. We love buying cars, and there's just a slide on Tina, who is the star of the show of our latest kind of brand campaign that we've got in market at the moment. And also just to highlight that we have a very good trust element in our brand. So we're the winner of 2 years in a row of the most trusted brand award in the used vehicle dealership. We're very proud of that. And it's a great platform for us to operate on in that used car market. Having a brand that stands for trust in a market that generally stands for the very opposite of that is a very good place to operate from. The confidence that we've got about the business sort of going forward has meant that we've come out with this 3-year target. And the formula that we've kind of hit on is really about these 4 things. So number 1 is about retail optimization. And for those who saw my little promo video that I shot outside our old site in Penrose, that is a really good example of us optimizing our retail network. So Penrose was a 40,000 square metre site. We've been in that site for nearly 20 years. It was really kind of almost the last bastion of our old auction wholesale business. And really for us, we've got a significant number of opportunities to be in more places, but also reshape a number of the branches that we have around the country to be more retail friendly. And the shot actually on the first slide was of our newest branch, Westgate. So that's a 10,000 square metre site out in the Westgate development here in the west of Auckland. And we are really focused about taking our branches to more places and being closer to the customers that are ending up in our business. We've also put a huge investment into our vehicle purchasing decision making. Like many retail businesses, we make our money when we buy. And we've put a huge investment into data, into training the people in our business who are buying cars, and a big investment into diagnostic tools where we get better information about the cars that we're buying before we make the offer. So yeah, big investment into making sure that we purchase the right cars at the right price. This focus on high quality borrowers in our finance business is absolutely working, and we know it's the right strategy to keep growing. So we've been a very early adopter of comprehensive credit reporting. I would say we're probably one of the most sophisticated users of comprehensive credit data in the market, and we will continue to focus our strategy around our sort of risk pricing and continuing to hone that to make sure that we are getting and winning market share in that premium lending space, which we know we are doing. And sort of underpinning all of that is this continued investment in digital, in particular by building out this omni-channel customer experience. And really, an omni-channel customer experience is providing choice to our customers, particularly in the auto retail business, about whether they engage with us sort of remotely, in person, with help, independently. But very much we know that most of our customers start their customer journey online. They may finish that mostly at the moment in the physical sense by coming into our branch, but we're certainly providing the choice for people that they can manage that whole customer experience of buying a car online, have a 7-day right of return, and give them the trust and confidence in the information that they're getting online, but the trust and confidence in the organisation turners that they're buying from. So where we've set the marker is that by FY24 we will be delivering 45 million in pre-tax profit, and that translates to this 31% growth over the next 3 years, and that results in dividends in that FY24 period, sort of based on current payout ratios of 24 cents per share. So shareholders should feel confident about the future. We feel confident about the future, and that should result in much better returns for our shareholders. One thing we've also done as part of the annual results presentation, as part of this sort of roadmap to 45 million, is give people a sense for where the growth is coming from. So largely the growth comes out of the auto retail business and the finance business. So that's where a lot of our investment goes. I mean, just to give you kind of some colour to, particularly to the auto retail growth, that comes largely out of new sites and growth from our existing network. We have 2 of those new sites already locked in for delivery sort of over the next 6 to 12 months. So that's new branches in Rotorua and Nelson. So these are properties that we've already secured. We have the developments underway, and we'll be opening Rotorua in a phased kind of rollout starting from September, and then Nelson will kind of come on stream early next financial year. The finance growth really is driven out of direct lending and improvements and growth in our distribution network. So that's that just gives you a bit of a sense for where the growth is going to come from. I think it's really important to make sure that shareholders understand that we have a very strong focus on organic growth. So that means we have no plans to raise further capital. We believe we can keep optimising these businesses within the group around margin expansion. We know that we're growing market share, and we think we can keep growing that market share with the things that we're doing. We're very focused around a sustainable dividend growth. So between management and the board, there is around sort of 35% of shares held by the board and management. So there is a strong alignment between what they want and what other shareholders want. We will consider and look at opportunistic bolt-on acquisitions. We've looked at a few things over the last couple of years, but really our primary focus is around that organic growth. And we're really looking to press home our scale advantages, and particularly through the digital investments that we can make. If you think about the car market in particular, we are the largest player by a factor of around 4 times. The market is very, very fragmented. So we have the resources and the scale and the sort of wherewithal to keep making these digital investments and really creating a strong competitive advantage to keep the growth going over the next 5 years. Okay, James, I'll hand back to you for any questions for Aaron and I.
Fantastic. Thanks very much, Todd. Great to hear about also all those aspects of the business. Fantastic growth story, absolutely. We do have quite a few questions, so we're not going to get into all of these, so I do apologise. As I said to everyone before, we will get the questions over to Todd and Aaron after the session. Let's start with, so this is a long question, but I'll read it out as is. With an obvious increase in sales post-COVID driven by Kiwis being forced to spend their dollars locally, what kind of investment is Turners making to ensure the company is successful post-COVID? How do you keep momentum when the dollars start to disappear offshore on travel, etc.?
Yeah, I think I would go back to my comment around the used car market being primarily driven by need. And just to give you a sense of where the used car transactions are, so if you look at the whole used car market in New Zealand, calendar year to date, we're tracking around 3% behind the 2019 market. So I think it's a real stretch to say this market is being driven by kind of people who aren't traveling and kind of COVID sort of incentives and injection of capital into the market. This market is driven by need, and we are seeing performance now kind of post-COVID that's quite significantly ahead of where we were pre-COVID.
Okay, great. Thanks, Todd. Another one is, how does Turners foresee clean car tax impacting their future and their organic growth?
Do you want to take this, Sarah?
Yeah, sure. Yeah, I think those changes really will impact importers, new and used importers. So a big impact on the new car business, a significant impact on used car dealers who rely for most of their stock from imports ex-Japan. For us, it's sort of circa 10% of our inventory currently is sourced out of Japan, and we've really pivoted to focusing on sourcing much more of our stock locally. So to give people an idea, there are 4 million light cars and light vehicles registered on the New Zealand roads, and we sell just over 30,000 vehicles a year for a 6% share of the retail market. So we see a huge opportunity to source locally and essentially replenish our inventory through the locally installed base, and probably reduce our imports even further once the Clean Car Standard and penalties and rebate scheme is fully introduced next year.
Okay.
Yeah, I'll just add one further comment there, James. Yep. I think one impact of these regulation changes that we will see is used car prices continue to increase. So that is just something for people to be aware of when they're shopping.
Is that a buy now message?
Great, fantastic. We're actually slightly over time, so a couple of other questions we'll get through to you offline if that's okay, gents. So we'll probably leave it there. Fantastic. Okay. Thanks so much for presenting this afternoon. Thanks to the audience for all your questions. Todd and Aaron, I'll see you again soon in the near future. I'm sure we'll do another presentation with you guys again.
Great. Thanks, James.
Thanks, James.
Thanks very much. So that concludes this month's Retail Investor webinar. So again, once again, thanks to our presenters, to you, our audience. Just to note that we are going to be increasing the frequency of these sessions and over the course of the 2021 and into 22. So we'll be hearing from more issuers. So look out for the next one in the coming weeks. And otherwise, wishing you all a pleasant afternoon. Thanks very much. Bye-bye.